Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. It's Quincy Krosby. Thank you for joining me. This is The Talking Point. It is Monday, April 17th. We started off last week with the earnings from the big banks on Friday, and they actually did a very good job. Came in and basically offered solid guidance. The numbers were good, and the market responded immediately to the reports. What happened on Friday afternoon, though, was very interesting. It had to do with commentary. And remember, we have heard Fed speakers all of last week. They have been on both sides of the debate as to further rate hikes. There's the head of the Chicago Federal Reserve Bank, well-known economists, saying, maybe we ought to pause and just watch to see what happens. And then we've had, a couple saying, hey, one more and then we're done. But then later in the afternoon, Christopher Waller, who is a voting member of the Fed, and he's considered to be, I would have to categorize him as a pragmatic hawk. But he made the comment, he said, look, we're not done. We've got a lot more work to do. And he added to that, he said, the fight may be longer than expectations. I can tell you what happened. The market sold off, and the U.S. dollar ticked higher. I mention this because there are a lot of questions about the U.S. dollar for a variety of reasons. But right now, I'm just looking at the dollar in terms of its softening against other currencies. I want you to keep this in mind. When the dollar weakens during a period like this, it has to do with what's called the interest rate differential. So that means that is the Fed going to be aggressive for a long time, as it was during its campaign, right? Raising rates 50 basis points, 75 basis points, on and on and on. The dollar climbed much higher than other currencies. And that is that we, if you want to call it, enjoyed the differential, the interest rate differential. Now, what you see is the euro has it. And why? Because the expectations are that they have to work a bit more than we do to get to 2%, which is their target as well for prices and inflation. So in any event, I want to point that out. But after Waller spoke, and as he was speaking, the dollar ticked higher. I'm not saying it screamed higher, but it ticked higher. There's still an ongoing debate as to whether or not we will have another rate hike following what the market expects is a rate hike in May. Right now, for June, the probability is still low. It's just about, about 20% probability that we may. That's at this point, that is negligible. But the rate hike expectations in the futures market for May is now over 85%. So in any case, I want to point that out for those of you who follow the currency. And keep in mind, a weaker U.S. dollar helps our monthly national companies be more competitive. And it also helps countries that import oil and import commodities, because most of them are priced in U.S. dollars. It helps those countries, particularly many in emerging markets, that have debt that is based in U.S. dollars. And it's easier, obviously, to service that debt when the dollar is weaker. I want to point that out as well. Now, when we looked back last week, a couple of very interesting positive moves, and that was industrial production actually came in. It was higher than expectation and an earlier revision higher. However, the National Association of Independent Businesses, these are the small businesses who, by the way, are responsible for much of the hiring in our country. The survey came out, and I remember these surveys are backward looking, but a good portion of them said, look, we're not seeing pressure on wages. That's easing, right? And that's very good news. That's what we want to see. But they did say that they were concerned about the ability to secure loans. This is an issue for the market because Loans are incredibly important for small business owners as they are for consumers, right? Consumers buying cars. I don't need to go over all the list of things, but if you can't get a loan, or if the loans are difficult to get and the standards are extremely high and the rates are extremely high, it is going to decelerate economic growth. I just want to point that out. And you've heard many say, well, doesn't that do the Fed's job for it? Sure it does. Obviously, the more the economy slows, the less the Fed is going to have to do. But nonetheless, the hope had been that the Fed could get to the point of price stability, which is, again, 2% inflation, get close enough, not necessarily 2%, but end the year close enough that it's clear that the Fed is winning the battle. But my point is, I don't think the Fed, while they acknowledge that the market could do its job for it, that's the way they want to go, because you don't know how deep it'll be in terms of stress, in terms of securing loans. So I wanted to point that out from the National Association of Businesses. The other thing I want to point out, again, from last week, is that we are seeing the data come in, but the question, is, are the data up to date? So when we saw the Consumer Price Index, one of the things that we pay very close attention to is we pay attention to the headline, right? The Fed doesn't, supposedly. But, if you are someone who drives a car, you're someone who feeds your family, you pay attention. And so one of the things that brought the headline number down in the CPI last week was lower energy costs. But guess what? Anybody take a look at gasoline prices? They're up now. So that was not factored in. Nonetheless, overall, the trajectory is actually moving in the right direction, but slowly. And it's clear that the Fed still has a bit more hiking to do. The question is how much, A, and B, how much, again, does the stress in the credit market actually help the Fed do its job? So we'll keep that in mind. Now, the other thing I want to mention from last week is the view when the minutes came out. When the Fed's minutes came out, the market, has gotten used to the fact that, the minute the Fed is finished with its, press conference, the Fed speakers are all out there with their opinions, right? Aren't they? I mean, how much more are you going to learn from the minutes compared with what they're saying in a up-to-date moment? However, we did hear something and read something that was different. And that was, in the minutes, it talked about a report made by the Federal Reserve economists. They call them in-house economists. The Fed has, about 400 PhD economists working at the Fed's headquarters regarding the possibility of a mild, quote-unquote, mild recession hitting by the end of this year. Now, much of that was predicated on the fact that they said, look, we could see, difficulty in getting loans, stress continuing in the banking system, leading to difficulty in getting loans, and that could actually, dampen the ability of businesses and consumers, especially small business owners, to get loans. So that was it, but that caught the market's attention. But one thing I will point out, these economists also had been working on, and they do a lot of work for the voting members of the Fed on inflation leading up to the Fed beginning to raise rates. Their reports underpinned that the inflationary pressures that we're building were transitory. And transitory. So I rest my case. So moving on to this week. This week, the market has a lot to digest. In terms of earnings, there are more banks, Goldman Sachs, Morgan Stanley, Bank of America, and regional banks and also some small banks. So that is going to be important. Not that small banks, so small, but we're going to hear from a broader spectrum of banks, and it's going to be extremely important. Obviously, we are also going to get Netflix and Tesla this week. We will have Lockheed Martin for the defense sector. This is important because defense stocks have been doing very well. And also we will have Procter & Gamble, which is obviously a major representative of consumer staples. So I mention these amongst many others that we'll have this week, but because they represent different parts of the economy. In addition to that, this week, we had some good news today, and that is that the Empire Fed Survey, which, by the way, is New York, part of Connecticut, and part of New Jersey, actually saw its manufacturing turn higher after 5 months of negative growth, if you could call it growth, of negative reports, turned higher in terms of new orders, but also we saw the prices paid component down. This is important, and I do want to point out that what this is, it's the Federal Reserve around the country, the regional banks, coming up with manufacturing reports. I have to point out that New York, it's the Empire Fed Survey, is not a leading indicator, but it is a positive that it was able to turn up. This is important. Important this week will be later this week when the Philadelphia Fed comes out with its survey. Why? Because the Philadelphia Fed Survey is a harbinger of the rest of the country's manufacturing. It tends to come out with a report that we will overwhelmingly see reflected in the other regional reports. So this is very good news, extremely good news, even though it only, quote unquote, comes from New York. The other thing that we're going to see this week, which is important because we're all following the housing market, we saw mortgages rates come down, we saw buyers come in, and we'll probably see more reports of refinancing. But this week we're going to have a series of housing-related data in terms of existing home sales and also the new home sales. So that's going to be important for the market. But I would reckon to say that also what we're looking for in the market, when I said new home sales, I mean housing starts, all right? Because that's important. So existing home sales and housing starts. But I also want to pay attention to the conference board. That is coming out toward the end of the week. And this is important because they will have their indicators. And again, we're looking for a turn, hopefully a bottoming in terms of what the conference board has to say. And remember, this is for March. So we're looking back. We always want to have up-to-date reports, but we're looking back. But nonetheless, it's going to be, I think, extremely important. And then also, I do want to point out that we are going to have the Beige Book coming out on Wednesday afternoon. This is, again, from Federal Reserve banks across the country. It is anecdotal, but one thing about it is it's much more up-to-date. It's anecdotal. It's up-to-date. The Federal Reserve banks talk to small business owners, large companies. They talk to banks to get a picture of, in their respective regions, what is going on. And this, particularly during periods like this, it's extremely important. So in any event, I also want to add that we are going to have to endure quite a bit of Fedspeak this week. And remember, what we're seeing is they're coming out, and they are coming out with their respective views. The doves are coming out with their views that maybe we should stop, maybe we should pause, and the hawks are coming out with, no, we're not going to do that. We got to keep going. We got to do what we can do to staunch and quell inflationary pressures. We expect that will continue this week. And so as we move into this week, it's an important week for data, but overall, it is the guidance that we will have from the companies that matter. So far, so good. right? But that was just a smattering of earnings reports last week. This week it gets heavier. And what we really are focused on, more than we've seen in a long time, we want to hear what they have to say, what they're seeing, and that's the guidance. So we'll follow what the Fedspeak has to say, but we will follow the guidance and we will follow the data. Have a very good week. We'll be back next week. Thank you so much. This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.